I tweeted this. I was like, this is just the start. The first time someone was able to kind of put toxic flow into the vaults, I was like, they only escalate from here, which is true. And we're seeing it, right? Once people see that there's money to be made, then they will now be probing everything, right? Every single angle, every single, potential exploit, they'll keep doing it, right? And so my view was that this was going to escalate. They were going to find other flaws. And it is a really challenging thing to have a live system that, there's a trade-off between locking a thing down and making it exploitable and making it useful. And you have to find that trade-off space in real time. It's a nightmare.
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin.
We are now featuring quotes from listeners on the show. Today, we have comments responding to my interview with Doug Colquitt about the jelly attack on Hyperliquid. On X, Joshua Carlson says, quote, "It's either decentralized or it's not. A platform should not claim it is fully decentralized if at any moment humans can intervene to change the rules or circumstances in its own or others' favor. What's the difference between that and a human at a bank deciding that it's no longer going to let people withdraw their money or make trades or turn off the system for a day or two while it fixes its risk posture? To have your comment featured, write a review of the podcast overall or leave a comment on our video on YouTube or X."
This is the April 1st, 2025 episode of Unchained.
Crypto moves fast. It's why Bitwise launched the weekly CIO Memo, a jargon-free summary of what's moving crypto markets, written by one of the best in the business, CIO Matt Hogan. Get up to speed in 5 minutes or less. Check it out at bitwiseinvestments.com/CIO Memo. Carefully consider the extreme risks associated with crypto before investing.
Today's guest is Kain Warwick, founder of Infinex app and Synthetix. Welcome, Kain.
Thanks for having me. April 1st, April Fool's Day.
I know, I had the same exact thought. Maybe we'll find a way to make a joke that doesn't sound like a joke, but we'll see. All right, so you've been in crypto for a long while, and I know, of course, you've been on the show before, but obviously you've done multiple things. So why don't we start off by reminding people how you got into crypto and just give a little bit of your background and the various things you've done.
Yeah, for sure. So I came from an e-commerce background, and I got into Bitcoin when I was running an e-commerce website because I genuinely thought that there would be a use case for this kind of bearer asset that could be used on the internet. That was the thing that kind of hooked me. The actual peer-to-peer payment network aspect. Obviously, that has kind of unraveled a little bit as a narrative, but that was the thing that hooked me into crypto. And then from there, I started dabbling in some Ethereum stuff, and then it was basically stablecoins that really hooked me. There were a few different use cases, prediction markets, tokenized equities, but stablecoins really hooked me. And that was the kind of jumping off point for building Haven, which was this stablecoin protocol that eventually evolved into Synthetix.
Okay. Yeah. And now you're doing Infinex, which we will talk about in a little bit. But the reason I thought to have you on the show is because you had an interesting thread recently about market makers. And they've been in the news a little bit recently. Probably the main incident people are thinking about is when Binance kicked off market maker from Move. But why don't you just tell us a little bit about what your thoughts were on market makers?
Yeah, so I've had a few of those threads over the years where I feel like there's things that a lot of people in the space who are active builders, who kind of in the trenches building know, but the average person on crypto Twitter may not necessarily know. And it's interesting. Sometimes it lands and people are like, this is the craziest thing I've ever heard. What are you talking about? And sometimes they're like, no, we all know this. So it's hard to know exactly how it will land, but that market maker thread definitely, hit a nerve, right?
Yeah, I actually realized I don't know this so much about this area of the market, even though I've been in crypto for a long time. So yeah, it was interesting to me how it kind of all works in the background.
Yeah, I think part of it is that market making in crypto has evolved a lot, and it is a very kind of wide-ranging topic versus, say, in TradFi, people understand what market makers are. It's sort of a known thing. I think particularly given there's much more regulatory scrutiny, what market makers can and can't do is much more constrained, right? So they really are there to add liquidity, and quote around mid-market and, provide tight spreads and all of the things that you sort of expect. In crypto, market makers can't help themselves but branch out into other interesting areas of the kind of problem space. So this thread was really about that. It was like, what are market makers doing? What is typically the role that they play? And particularly around, as a builder, how do you engage with market makers? Which I think was maybe the most interesting thing for people, particularly going back to the ICO era. There was a period in time where you had to have a deal with one or two market makers in order to be able to get exchange listings, in order to be able to even get investment, which is a bit wild if you think about it, but that was kind of the way that the market was structured at the time.
And what you said when you were talking about the 2017, 2018 ICO era was you said it wasn't long before these market makers realized they could pivot to all out crime. What did you mean by that?
So I think that, if your job is to quote, bids and offers and have tight spreads, and your job is to basically provide liquidity, then that is supposed to be kind of a neutral process, right? Like you're kind of, clipping pennies on the dollar, over a lot of volume, but you're supposed to just kind of stay neutral, right? The thing is, because crypto markets are so illiquid, particularly on certain venues, it was very easy for some market makers to be like, well, what if we just juice up the buy side a little bit and see what happens, right? And, you add a bit more liquidity on the buy side, you push the market up, and all of a sudden, these market makers will realize we can really move the market, right? We can actually have an impact on where mid-market sits, because there isn't that much liquidity other than us. And so if we just move stuff around, we can really, play around with this. And so I think that a lot of market makers, once they had that realization, it's hard to avoid doing that, particularly when they have incentives that are either paid in tokens, or they've got a loan, or they've got some other structure that gives them an incentive to move the price, whether up or down, right? The interesting thing about this is that I think 7 years on from this, most of the good market makers that you expect are not doing this, right? The ones that you've heard of, they're not necessarily moving the market, but most of the participants who are in crypto today grew up through that ICO era, even 2020, 2021, particularly with Alameda, who were very aggressively moving markets. And so they have this expectation that that's what market makers do. Market makers are there to move the price. And so when the price goes down, they start pointing fingers at, Wintermute or whatever and saying like, Wintermute's making the price go down, just make it go up, right? That's not really how it's supposed to work.
And I was curious, do you want to name any names from 2017, 2018 where those tokens you feel, experience that?
So genuinely, I think that it was almost every single ICO. Almost every single ICO, particularly when they would get listed on exchanges like, some of the Korean exchanges, there was a lot of just natural buyers, retail buyers on those exchanges. And so oftentimes it was the job of the market maker to even, try and tamp that down and arbitrage between the two, because the spreads would get crazy, right? The kimchi premium was insane for Bitcoin, let alone for, sometimes it was like 50% premium for illiquid tokens, right? So there's a lot of ways that you can make money if there is no kind of efficient arbitrage mechanism there. And so the market makers would really take advantage of that. To be honest, I can't even remember the names of most of these firms. I think they're all dead now. I could probably try and like dig it up somehow, but they were very fly-by-night operations that, would last for maybe 6 months or 9 months and then sort of disappear. I think a lot of the people who were doing that at the time eventually pivoted to either, running their own prop fund or something else. So some of those people are still floating around in the ecosystem, but not necessarily market making anymore.
Yeah, honestly, what you're describing here reminds me of how, this is like a pretty common observation, I think, about the crypto space, but it is so easy to make a lot of money without actually accomplishing anything that a lot of people kind of do that and then peace out, or they, try their hand at something else or whatever, whatever. But the point is like, it is, and this is why, to the outside world, there is a reputation that crypto has, and I can understand it. I think, I do think sometimes it's like too negative to the point where they don't recognize that there are serious people who are trying to build something real. But for sure, like I would guess more than half of people are kind of the more unsavory type that we just described.
I think, it's in a nascent market, right? That's very inefficient. It is easy to come in and extract value, right? Like there were people who were able to just come in and, make a lot of money extracting value, like really not delivering anything or not making the markets more liquid or doing anything you would expect a normal, market maker to do and just, get tokens. But the same thing was true for marketing firms. Back in the ICO-era, there were all of these marketing firms that would help you with writing the white paper and help you with, getting this partnership. And they would extract like 1, 2, 3, 4, 5% of the token supply, depending on the team.
Wow.
And obviously just turn around and just dump that. And so by the time we got to like mid 2018, there were multiple firms in Singapore that were set up that were just ICO mills. They were just pumping out teams, helping them raise, extracting, as many tokens as possible, and then rotating to the next one.
Oh, wow. Okay. That is, that's super interesting. And I imagine that some version of that is also happening today. But let's keep talking about the market making, because
Sure.
At a later point in your tweet thread, you said, you referenced the current call option structure. And for the less financially minded people, that's a contract that, like, you're referencing something like a contract that would give the buyer the right, but not the obligation to purchase the underlying asset at a specific price. How does it work? So when you describe that, how does this work today?
So today it has evolved a little bit, and I haven't been directly negotiating a deal like this for a while, but word on the street was after I tweeted that, a few people reached out and said, well, actually it's evolved a little bit. It's not exactly that same structure. So that structure was basically, you're launching a token. You're going to give me the ability to buy, let's say, 1% of the token supply at, let's say it's trading at $1 today and it's on, a couple of exchanges, but you haven't got a big exchange listing. So you'll give me a call option to buy the token at, say, $2, right? And the theory behind this, right, is not that I'm going to take those tokens and push the price up. Although, again, back in the old days, that was kind of the intention, right? That, someone would basically inject liquidity in, add some volume, especially on the tier 2 and tier 3 exchanges. But the idea is that if you're going to get a listing on a larger exchange, that will naturally inject liquidity. Someone will need to be there to quote on the token around mid-market. And so if I do a good job as a market maker and make the market as liquid as possible, and I'm quoting really tight spreads, then what will happen is people will naturally be more comfortable buying the asset because they feel like they can get in and out really comfortably, right? Whereas if you want to buy $50,000 of the token and it's going to be a 5 or 10% spread, or, as in the price impact is 5 or 10%, so 10% to buy $50,000 worth of a token, you may just not buy it. Whereas if you can buy $1 million with a 1% spread, then you'll go, okay, this is a liquid token. I can easily get in and out. And that just creates more incentive for people to trade it. The liquidity begets more liquidity. And so you can do a really good job as a market maker that makes an asset more liquid, and it's therefore inherently more valuable as a more liquid asset. And so then if the market, is kind of improving and liquidity is improving, then naturally the value of the token should go up. And then you have this call option, which you can exercise to buy those tokens. And, then you have your own liquidity that you can sell into the market later. And that's how you can get paid.
Okay. But when you said that now it's evolved a little bit, like what does it look like now?
So it's evolved into more so there was always this loan component plus a call option, but the loan has become much more aggressive, right? In the sense that it's a much larger percentage of the token supply than it used to be. And there's been some funny incidents. Like one of them you may remember where Optimism gave a token loan to Wintermute, but the token was on OP chain, and Wintermute didn't check to make sure that they had control of the safe that was on OP. And so the tokens were sent to a multisig on OP, but the multisig didn't exist. If I remember correctly, the amount of tokens was large, but not, single digit percentages of the supply. It was like 20 million tokens or something like that. Today, those loans have gotten much larger, is my understanding. And, you're talking 2, 3, 4, 5% of the token supply is being loaned out. Now, in theory, that's not necessarily bad because it means there's potential for more liquidity. In practice, it can create some perverse incentives, right? Because if you have a giant slug of tokens that have been loaned out to you, plus you've got this call option to buy them back, and you've got a situation where the token is very low float, right? So let's imagine that there's only 5% of the tokens circulating, and you've also got 5% of the tokens that have been loaned to you. Well, the actual circulating supply is 10%, right? It's just you control half the market. It's basically allowing a market maker to corner the market on a token. And at that point, you have significant market power. Plus, you've got this call option strategy. So the theory goes that people have been dumping into this, low float, and then basically covering it later, by either exercising options or, just basically buying back lower and letting the option expire worthless. But you got the loan, right? So you're now essentially shorting the token, but you're not worried about it because you're like, I'm 50% of the market here. I know what's going to happen with this token. So that's a very different structure. And again, you can imagine a world where that's fine if the market maker has the right incentive structure. You can also imagine a world where that's really not fine for all the people holding the token because one person controls the market.
Wow. Yeah. So then you had like a description of what you thought would be the optimal way for the market maker to act. So do you have, what's your like ideal, like kind of best case scenario?
I think the problem with the low float meta is there really is no ideal case, because for you to have enough tokens as a market maker to be able to, quote around mid-market, you will naturally have far too large of a percentage of the circulating supply, right? So, that means ideally you want 15 to 20% of the token supply circulating. Now, you can do that in a bunch of ways. You can have airdrops, you can have, there's a lot of different things you could do, but you just don't want one party to have such a large percentage of the circulating supply that they can really control the market. And so it's almost impossible with the low float meta to get this right, is my take, right? So you have to actually get the liquidity of the token out there, done correctly first, and then you can structure a deal with a market maker that, is kind of incentive aligned, I suppose.
And do you feel like teams are trending that way, or?
I mean, the problem is, right, that as a team that's about to launch a token, you have control over the initial token structure, right? And so the incentive to kind of have the FDV, even if the market cap is low, the FDV as high as possible, is really powerful if you think about it, right? Because then I can come to anyone in the space, anyone that I want to incentivize and say, hey, I'm going to give you $1 million worth of tokens, right? Now, if the market cap is 100 mil, right? And that's 100% of the circulating supply. That's a big chunk of the token supply. But if it's trading at 50 billion FDV, it's a tiny fraction, right? And so I'm kind of incentivized to be able to, create this very high FDV. So I can go around offering tokens to people. And it's like, hey, here's $5 million worth of tokens. Here's 2 million. And everyone's like, I guess it is. I mean, it looks like it's trading that way, right? The market cap and FDV do reflect that. And they've got a couple of exchange listings. So maybe I'll take that deal. And you just have a lot more dry powder versus a token that, maybe launches at a 50 or 100 mil FDV, right? And then has to, create enough incentive for people to want to participate in the project, but you can't just be slinging $10 million worth of tokens around in the way that you can if your FDV is 50 billion.
Right. Well, so for people who want to participate in different types of tokens that are launching, how would you, not that we're giving financial advice, but when you at least are kind of analyzing them, like what are things that you look for to kind of figure out whether or not it's structured in a way that is at least fair?
Yeah, I think I always look at FTV, right, over market cap. And it's funny, there's a bunch of people that I discuss this with regularly, right? And even in some very smart circles, people are like, doesn't matter, the market cap's low, right? And this conversation happened with Trump coin, because the problem is you have this Keynesian beauty contest as well, where people who are trading the tokens go, no one looks at FTV, so I'm not going to look at FTV. Because if no one's looking at FTV and everyone's looking at market cap, then what's the point of looking at FTV, right? So there were a lot of people that like, but 80% of the supply of the Trump coin is locked up. So really the market cap is only 5 billion. And that's low for a presidential token, right? As if there's some precedent there of like what presidential tokens should trade at. But they're like 5 billion for Trump coin seems low. And it's like, but it's not really 5 billion, it's 5x that or 10x that or whatever. And so there's this kind of psyops of like, well, if no one's paying attention to that, then I shouldn't pay attention to it. But I always look at FDV and try and understand, okay, is this FDV sustainable? If that FDV is based on 3% of the supply circulating, right, then it's probably not sustainable, because all things being equal, it would be much higher, right? For any given price, it would be much higher, if the float, were different, right? As in the market cap would be much higher. And can that market cap be sustained if the float goes 10x from 3% to 30%, right? It's hard to say, right, what the interaction between market cap and FDV will be, but that needs a lot of net new buyers to come in if people are selling. Now, and this is where people play a lot of games between market cap and FDV, what is circulating, what's not. And funnily enough, back in the day, people have tried this for a long time, right? Binance was the one that put the most pressure on teams. That chart that you've seen a million times where it shows the unlock schedule and it shows like team, where does it grow? Binance, to the best of my knowledge, was the one that kind of forced people into disclosing that, right? It was this kind of forced disclosure regime. You couldn't get listed on Binance without providing Binance with a spreadsheet that had every single buyer, how long they were locked for, what the locks were, when the unlocks happened. And that gave people a lot more clarity into, is this really circulating or not, right? Because people will play games where they'd be like, well, the circulating supply is 30%, but it's like, wait a second, are you counting the treasury? And it's like, yeah, because the treasury could sell it. It's like, but it's not going to, so that doesn't really count, right? And so there was all this, these different criteria that Binance was like, if it is in the treasury, it's not liquid, right? If it's in a staking contract where the staking contract is not liquid, then it's not liquid. You can't say, but yeah, there's a bunch in the staking contract locked for 4 years, right? So there are all these games that people play, and people are playing those same games today. It's just the game shifted a little bit. And it does seem like Binance has the most market power to shift these things. And it does seem like Binance has gotten sick of some of this nonsense, and they are starting to put some pressure on teams to not play these games. So, that will be an interesting thing to watch as well, right? To see where the market pushes people in terms of disclosures.
Yeah, this isn't the exact same scenario, but sometimes those token teams will have a graphic of the allocation, and then there's like a really small slice that like normally would be, I don't know, like let's say a 10% slice, but it's labeled 30%, but they just drew it like it's like 10.
Playing chart games. Playing chart games. Probably my favorite one. There's a chart, I tweeted this out ages ago. I don't know who made it, but it was one of the SAM coins. I think it might have even been Serum or something. And it was like the tokenomics chart, and it was like FTX, SBF, Alameda, FTX2, SAM, personally, like Sam's parents. Like it was just like the whole chart is like all owned by him, right? It was just different like slices that were owned by Sam or Alameda or FTX.
Yeah, yeah. I mean, it's ridiculous too, because it's like if you do it like that, then it's definitely going to fail. But, it's just what we were talking about earlier. Like in the meantime, you've gotten rich quick, and like who cares if, people get wrecked, or if this, lasts longer or indefinitely. Well, let's actually now just talk quickly about what happened with Move on Binance.
Sure.
Essentially, this market maker, as far as I understand, netted a $38 million profit rather than doing like, neutral bids and offers on both sides of the market. So what do you think of what happened there and how Binance handled it?
Again, I think this is one of those things where the incentive is always keep extracting, keep pushing the envelope, keep trying to do whatever you can, especially when people feel like this is not a multi-round game. Right? If it's a single round game, then each team is incentivized to try and max extract, right? But Binance is playing a multi-round game. So they need to constrain what people are doing. And, for whatever reason, Binance got, maybe they were distracted, who knows, right? But Binance got to a point where they weren't putting as much scrutiny, I don't think, on some of these things. And also, people are very good at kind of obfuscating and playing games and, doing things. And even for Binance, it's hard to keep track, right? There's like huge incentives on the other side to play games with these things. And so I think basically what happened is my sense, is that it just got pushed further and further and further. And eventually Binance was like, no, like this is not okay. And remember, there's multiple different parties involved in this, right? It's not just the teams, it's also the market makers, right? And the market makers are playing a multi-round game, but hiding it oftentimes as well, right? Like they've got different entities, different structures, and they've got different accounts even on the exchanges, and they're trying to obfuscate what's going on here, but eventually they're going to get caught out. And so I think what happened is that it was just pushed a little bit too far. And back in the day, there was an incident that happened with Cosmos where they had their unlock chart and they had their tokenomics pie graph, right? And they went and loaned something like 5%. It wasn't even, it might even be less than 5%, but they went and loaned 5% to a market maker, and the market maker started selling. And people were like, wait a second, this is supposed to be in the treasury, but it's actually sitting with a market maker on Binance. That's not what you said. Like you said, this is locked up in the treasury and it's actually liquid on market. And people lost their minds, right? Which is, so quaint now, because then every single person was like, wait a second, we can do this. And so they started, playing games and trying to do it. And again, I just think that people push the envelope as far as they can. And then Binance gets to the point where they're like, sorry, no. And they crack down. And I think that this was, for whatever reason, the straw that broke the camel's back. And Binance was like, you have to stop doing this. It's bad for users. It's bad for the ecosystem. And we're not going to allow it anymore.
Yeah, it feels like there probably needs to be some sort of standardization around certain, norms, but yeah, we're not there yet. Especially because, it's so international, and I'm sure there would be a certain kind of like race to the bottom amongst exchanges in different jurisdictions.
But, I do think like Matt Levine had a really interesting take a few weeks ago on this when the crypto, task force was announced, right? That like we've sort of put up with the permissionless nature of crypto in the sense that it's very low barriers to entry and people can do whatever they want, but we try to create norms and we try to create, the right structure to not let people extract value, because it is net negative, right? We saw this with meme coins. Everyone realized that this is net negative. If you let, the LA vape cabal and the, Dubai cabal and, these various cabals just keep extracting value, they're not keeping it in the ecosystem. They're pulling it out and they're, buying Lambos or whatever they're doing. And that's net negative for the ecosystem. There's less liquidity there. And so I think that there is certainly a view for people who are doing, who are building genuine things, that it would be better if we could have fewer scams. But the question is, what's the real trade-off, right? If the trade-off is that there's this really harsh disclosure regime that incurs a bunch of costs for every single project, right? Then the trade-off is potentially worse because what you're doing is raising barriers to entry. You're making it much harder for a project to participate. You get, less capital formation. You get all of these unintended consequences. And it's a genuine, like, kind of ideological question of, would we prefer this laissez-faire open thing, or do we want, something that's more like TradFi with very harsh disclosures and therefore, costs that go alongside that?
Interesting. But I guess I think that there would be a way to not make it too onerous. Like if you just, well, I don't know.
That's always how it starts. It's like, just give us these 3 little pieces of information, right? And then it's like, what about a 4th? And then all of a sudden it's like, how do you feel about, the like ice caps melting? Like it just, it just accelerates and accelerates, right? Because there's someone sitting there whose job it is to mandate disclosures, and they're like, just 3 more disclosures, bro. Like that's just 3 more and we'll have it like all locked down.
Right. But I guess, okay. Well, I do think no matter what, though, there should be something around this, allocation, probably that would probably just be the main focus, at least for the exchanges, whether or not like your white paper, whatever is up to snuff is probably not super, or not that it's not relevant, but that gets into the territory more of like evaluating the asset rather than just like basic fairness around trading, which is, I think, where the exchanges should be focused. But I did want to ask, so just at the end of February, I'm sure you saw Citadel said it was looking to become a market maker on crypto exchanges. And I wondered what you thought that could mean for all these issues that we've been discussing.
So I think, net, it's positive, right? And a lot of people, there's a lot of stonks guys out there that'd be like, Citadel is the devil. How could, why would you want them to, play around, right? Because it's not like, there's the same meme in TradFi, right? That like Citadel is like manipulating prices and shorting things and doing all of this stuff, right? And again, probably they are shorting things sometimes, and, different people are shorting things, and, different people are doing different things, but that's part of market structure. Right? If you want an efficient market, you need people in there who are shorting things, because if you can't short things, then markets get distorted, right? So if we want efficient markets, we want good players, right? People who are good at doing the things that markets want them to do, which is liquidity and quoting tight spreads and all of that stuff. So I think I don't have an issue with Citadel coming in. What's interesting, though, is there's zero chance, at least from my perspective, that Citadel is going to be striking one of these, loan call option structured products with a, nascent L1. Now, I might be wrong, right? But I just don't think that they're going to touch that. They might come in and trade Bitcoin or ETH or Sol or whatever on Binance, but I doubt they're going to be participating in this, which is part of the problem, right? If you had, an entity, even if they're regulated in TradFi and they came into crypto, they're not going to be willing to max crime to extract value, right? They're going to play by some kind of rule book, even if it's gray. So I think it would be good for a team to do a deal for Citadel to market make their token. It's just, I think it would be too hard for them to get that over the line from a compliance perspective.
Oh, okay. Interesting.
I could be wrong, but it just, to me, feels unlikely. Now, that said, current regime, maybe it's different. It certainly I would say it would be impossible for Citadel to do those kind of deals. But, Jump and GSR, there's people out there that are, and people hate Jump, but I think my perspective on Jump is they were the most fair and transparent market makers that I've ever worked with, right? Because you knew what they were going to do, and the rules that they played by were really clear. And they also were in TradFi in a way that they couldn't do, there's no question that they made money, right? But it's okay to make money if you make money doing things that the market wants. It's when you're extracting value. Now, did they do some crazy stuff? Probably. But on balance, my experience with Jump was very positive. They were really transparent. They had very clear structures about how they were doing things. They didn't play games with token structuring and deal structuring. They were really fair and transparent. So I think Jump coming back into the market would be good, in the same way that Citadel coming into the market would also be good for the market. It will make markets more liquid.
Huh. Super interesting. All right, so in a moment, we're going to talk about what happened last week with Hyperliquid. But first, a quick word from the sponsors who make this show possible.
Hi, I'm Matt Hogan, CIO of crypto asset manager Bitwise. Look, crypto can be confusing. There's so much noise and the space changes so quickly. That's why, every week, I write a 5-minute memo on the biggest stories impacting crypto, in plain English. Why is Bitcoin up or down? What are people missing? Where should investors look next? Get the lowdown every week. Sign up to get the weekly CIO memo delivered straight to your inbox. Go to bitwiseinvestments.com/CIO memo. That's bitwiseinvestments.com/CIO memo.
Carefully consider the extreme risks associated with crypto before investing.
We have another listener comment responding to my interview with Doug Colkett about the Hyperliquid jelly attack. On YouTube, Carlos Ortiz says, if you can arbitrarily change one thing and you can change another, that's a debate, another fake principle of crypto. Again, if you want to hear a comment featured on the show, please write a review or leave a comment on an episode on YouTube or X.
Back to my conversation with Kain. So we are chatting the week after this big drama over what happened on Hyperliquid. And, people were kind of on both sides of how it handled this manipulation of this jelly meme coin on its platform. And I wondered what your thoughts were on what happened and how they handled it.
So back in the day when we first launched Perps, even before we launched Perps, when we first had an oracle on Synthetix that you could trade against, we had probably like a 3 or 6 month window where people were not trying to exploit the oracle, which lulled us into a bit of a false sense of security. And then at some point, they realized that there was value to be extracted, right? And this is back in the dark ages where pre-Mango markets, like pre anyone being punished for anything, right? Like people genuinely were, and including myself, right? Code is law. If you put an oracle out there and people can exploit it, it's kind of fair game, right? And so we had this kind of cat and mouse ongoing fight with people who were trying to exploit the oracle, which created tension for us to improve the oracle, right? That was part of, if we didn't have that, if people weren't trying to exploit it, then we wouldn't have needed to put as much effort into fixing it, tidying it up, and lowering latency and a bunch of other things. So we had this experience, and I tweeted this. I was like, this is just the start. The first time someone was able to kind of put toxic flow into the vaults, I was like, they only escalate from here, which is true. And we're seeing it, right? Once people see that there's money to be made, then they will now be probing everything, right? Every single angle, every single, potential exploit, they'll keep doing it, right? And so my view was that this was going to escalate. They were going to find other flaws. And it is a really challenging thing to have a live system that, there's a trade-off between locking a thing down and making it exploitable and making it useful. And you have to find that trade-off space in real time. It's a nightmare. Like it was a nightmare for us. Went on for years we were dealing with this, right? And so I just think that Hyperliquid is going to have more and more of these incidents, and they're going to have to tighten their parameters. They're going to have to tighten the system. They're going to have to, come up with a bunch of different ways of preventing these exploits. But there is absolutely a trade-off space here where it starts to be less good for users because of those things. You start to kind of impact usability and UX because you're trying to prevent exploits.
Huh. Interesting. But what do you think of how they decided to, handle it in a way that would be favorable to them, to the point where they actually made money off of the fact that out of something that was essentially their mistake is like the way you could think about it. Because I think the amount they would have lost was something like around 15 million, which, okay, I understand. Like, it's not like it's a super tiny amount of money, but for them, they could probably handle it. And instead they took some profit.
Yeah, I think, again, one of the challenges with a system like this is that if you have aspects of centralization in the rules, right, in the way that the rules are enforced or the way that the rules are codified, then that's the place inevitably where the exploit will happen almost, right? That, that aspect of centralization becomes a sort of point of weakness. And that's where people will push because they sort of hope that you won't be forced into, making the move that you inevitably will be, right? And so it will kind of escalate and escalate and escalate. And then it gets to the point where it's like, we've got to do something, because if they had taken that loss, right, they would have had two options. Take the loss, let the vaults eat it, at which point, you expect TVL would drop significantly, right? Same thing happened to Bybit, except Bybit decided to, cover the loss from reserves or whatever. TVL still goes down. But if you make the vaults eat that all, then TVL is going to go down much, much. If Bybit had socialized those losses across the exchange is dead, basically, right? And
I don't understand, because I thought the HLP had something like more than $200 million in it. So
difference between TVL and P&L, right? So the vault had, I think, 220 mil of TVL. That's not all P&L. There's P&L in there, right? But the P&L tracker of like how profitable has this vault been, if I put $200 million into a vault, doesn't mean it's made any money. Now, the Hyperliquid vault, I think it made about 60 million, maybe a little bit more. And so this would have been 25% of the P&L written off. So again, like not dead, right? But all of a sudden, a lot of people, especially people who had gotten into the vault later, would have had negative P&L, and then they pull out, and then all of a sudden the risk goes. So there, and again, this is not a novel situation. It happened to GMX as well. GMX had this, a socialized vault. Synthetix also has a vault strategy, although it's a little bit different. It's more hidden away in the core of the system. This is how a decentralized perps DEX kind of has to operate. There needs to be someone who's backstopping the P&L of traders, so that if something like this happens, because the thing that you don't want is to force traders to eat the loss. If you force traders to eat the loss, then that kind of blows up the game, right? And they're like, well, I'm not coming back here again. So you want someone else. You want someone else who's kind of pot committed to absorb the loss, which in this case was HLP. What they did, though, by changing the price, was force some traders to eat the loss. There were traders who were in profit who then, so again, it's a very harsh trade-off space, right? You got to choose. Someone has to eat this loss. To your point, could they have funded themselves? Like, I think they probably could have, but then the question is, what do you fund it from? Do you fund it from tokens? If you go back to like the BitMEX hack, right? They just invented a token and gave everyone.
Oh, Bitfinex.
They're like, here you go. Right? Like here's these magic beans, everyone. We've made you all whole, right? And so, there's a bunch of different ways you can play this if there's a hole in an exchange. None of them are good. You just don't want holes in exchanges, right? Like you don't want to, regardless of where the money comes from, it's not a good place to be. I think for Hyperliquid, the bigger problem is not where's the hole, how do they fill it or whatever. It's that they have been making this assertion that they are sufficiently decentralized, that they don't need to do all of the things that a centralized exchange does, but then they are able to, when push comes to shove, do things that are very centralized, that feel very centralized, that have like an ability to kind of, change the rules. And the worst thing you can do to a bunch of autists is change the rules. Like that's the thing that like you just cannot do. If you change, there's many, many examples. One of my favorite examples of this was the first time that Athena changed the payout on the APY, and everyone lost their minds. They're like, you can't do this. You can't change the APY. You can't change the way the calculation's done. It was one of the only missteps that I think Athena has made in the last 2 years, was this rule change, and they didn't anticipate how much people would be mad about the fact that the rules were changed on. They're like, there's a set of rules, code is law, you can't change things, and so again, I think that the problem for Hyperliquid is that this really showed that the emperor has no clothes, right? Like that they can do whatever they want, they have control of the system, they can change the oracle, and they have to now deal with the consequences of that decision.
Yeah, I mean, the fact that they made this decision in 2 minutes is something also that people were talking about because it shows clearly that it's extremely centralized. And then there were funny memes going around, like those captcha images, and it's like Jeff in all these different, you know.
I actually made that meme. I was the
You.
yeah. So there was a CZ meme back in the day. There was the Binance Smart Chain, which I actually stole from Stanny. Stanny showed it to me, and I was like, "I'm tweeting this," and I tweeted it. It got like, I don't know, a few thousand likes or whatever. And so then when this was all happening, I was like, "This is actually kind of funny. I'm gonna remake this meme with Jeff." So yeah, I was definitely the culprit there.
All right. Well, let's talk about Infinex because, as we discussed earlier, you've had a few different ventures in crypto. Yeah, you launched a new one last year. So, what problems were you thinking about? Like, what problems did you want to try to solve when you launched Infinex?
So, I think there are two eras to Infinex. There's the pre-launch, pre kind of me taking over the project phase, where I saw this problem with Synthetix where the exchange wasn't getting much adoption. And I had this thesis that most of the reason why I wasn't getting adoption was due to UX issues, due to latency on the front end, a bunch of, kind of front end related issues that could be fixed to improve the experience and would make the exchange much better. This is not too dissimilar to what Hyperliquid did. So this is going back to like May 2023 when I was really trying to look at the perp space and why we hadn't gotten adoption. And so Hyperliquid kind of did this, right? The real insight that I think Hyperliquid did that they nailed was making an L1. Making an L1 gave them a lot of flexibility in how they implemented this. But I looked at Synthetix and I said, we've got a very good matching engine. We've got this good exchange, but adoption has been slow. Why don't we build a centralized front end on top of it as an alternative to the decentralized dApp-based front end? And we spent about 9 months building that. And out of that project came Infinex. And Infinex became something much different to what that was at the beginning. But in March of last year, I was like, this is a big opportunity. I'm actually going to step in myself and take over the project because I had someone else who was running it. And I was like, let's actually figure out how to do this. Let's build something that is going to, allow us to not just make a better interface for perps, but to make a better interface for all of crypto.
Okay, so explain what Infinex does and how it works.
So what we built is a non-custodial interface for basically all of DeFi. And what we realized is that there was enough infrastructure that had been built over the previous 2 years to put something together that could give you the same experience as what you have on Binance or Bybit or Kraken or Coinbase, but without having to give up custody of assets. And while the average user doesn't care about whether a thing is custodial or not, right? They just want the best wallet experience or the best crypto experience. Being non-custodial and being on chain gives you the ability to tap into a bunch of different things that a fully centralized solution that's custodial by nature has a hard time accessing. So there's a bunch of different yield opportunities and the long tail of tokens that are not accessible to a centralized exchange. There's sort of marginal effort every time they want to integrate something like that. And some of those things are impossible for them to integrate. So centralized exchanges have gone down this path of trying to create a hybrid solution. You look at Coinbase, they've got an L2 and they've got Coinbase Wallet and then they've got the centralized exchange. And it's this kind of ecosystem. It's this hybrid thing. With Infinex, we just said, let's go all in on building a non-custodial interface for crypto. And we think that that's the right path forward and that the time is right for it.
And I see that you have multiple different chains. There's a bunch of EVM one. Well, so there's Ethereum itself, but then a lot of the large L2s, such as Arbitrum, Optimism, and Base. There's Solana. And there's also kind of like up and comers like Barachain, Blast, Unichain, Sonic. So how do you decide which chains to add? Do you have specific criteria that you're following?
There's some technical and architectural criteria that they need to meet in order for us to be able to do it. In theory, we can add any chain. right? Like there's, it's just software. So it's really been, what are the things that are most similar to other L2s, EVM-based L2s. There's some SVM chains that are launching, so those will be very easy for us to integrate. We probably will do Sui and Aptos and, Cosmos and some of these other chains as well. But at the moment, it's very easy for us to add an L2, especially if it's EVM compatible.
So Infinex does away with gas and bridges. So you guys, I guess, are taking it out of the price in some way? And then how do you handle the bridging? Because like if a user wants to go from one of the EVM chains to Solana, like how does that work on the back end?
So we have gas sponsorship everywhere on every chain, which means that you can move a stablecoin to Solana and not worry about having Sol for gas on Solana. You can then just do something with it. We sponsor all of the gas and on all of these different chains. You will pay a small fee for that, although we do have a structure in place where if you're holding our NFT, so we did an NFT sale last year. If you're holding our NFT, then you don't pay for gas, even on the kind of long tail chains, which means that you're basically only paying for gas on Ethereum.
Okay, so that's the patron token.
That's the patron token, exactly. Yeah. So yeah, we sponsor gas just to make it as easy as possible for people to quickly go to a new chain like Berachain and buy Honey, their stablecoin, or buy one of the yield bearing assets they have on there, and then we will roll out the ability to also go into some of the yield farms that they have. Sonic and Berachain are really kind of max APYing at the moment, right? Like trying to get to 100, 200, 300% APY back like the old days of DeFi summer. And so getting access to those yield opportunities is something that we're working on as well. So you'll be able to just go straight from holding Sol on Solana into some weird Berachain scheme and earn 200% APY.
Okay. And so for the governance token, patrons what type of decisions are people going to be making?
So this is a very good question, right? It sort of speaks to the same thing about Hyperliquid, right? When I started Infinex, we built it like a DeFi protocol. We built the governance structure like a DeFi protocol. What I've realized over the last 18 months is that may not be the best governance structure for a project like this. At the end of the day, and this is something that I'm working on at the moment. I've been sort of spending some time thinking about what is the optimal governance structure for a project like Infinex today. Not 6 months ago, but today, given the current regulatory structure that we are operating in. And I think that we probably over-optimized for decentralized governance. That said, there's no question that you need some checks on power when it comes to decentralized systems. Because if you have a non-custodial system and the people who are operating it can take control of your funds, then it's not really non-custodial. Even if they are non-custodial most of the time, if they could go and deploy something that would take your money, you need a way to basically prevent that from happening. And so the way that I've been thinking about this is that it's sort of management by exception. You delegate authority, and this is how Synthetix ran as well, right? You delegate authority to a council to make decisions, but you have the ability to basically intervene and block those decisions if they're bad decisions. And so there needs to be a mechanism by which the people who are, holding patron NFTs can stop something from happening, which means you need time locks and, there's some things that are important there, but you need the time locks just in the right places that are risky. And then you need to really just hand over control to the team that's building the thing to allow them to move as quickly as possible, because the market is very competitive now. So I'm working on this rethinking of what Infinex governance should look like, and hopefully it'll come out in the next month or so.
Yeah, I would imagine that it's one of those things where you need for their, because it's kind of new, I guess it's just not even a year old at this point?
Yeah, about a year old. Yeah, we launched in May of last year, so not quite a year of live.
Yeah. So I feel like there needs to be more of just like a what's the word? Like a self-sustaining economy. And during the time when you're kind of new and building that, then it would make sense for it to be more centralized. So Yeah, it just sort of feels like governance would be something that would kind of come later after it's more established. I did invite questions from people on X for you, and DeFi Ignis was curious as to why Infinex is prioritizing the web app first rather than a mobile app. He said he felt Infinex would get more users with a mobile app, and then said, quote, I feel he, meaning you, Kain, has a Western bias prioritizing website page, which I don't even know if that's a Western bias thing, but anyway, what's your response to that?
I probably do have a Western bias. So, that definitely, that lands. I think that the reason why we built a web app first is probably a little bit of path dependency, in the sense that we were planning to roll out perps first, and we ended up rolling out other things before perps. Eventually, we will roll out spot and perps. So I think you need both. I would argue that it is easier to iterate, particularly in the early days when you're trying to figure out what you should build. It's easier to iterate in a web app than it is in a mobile app for a bunch of different reasons. That said, we absolutely do need a mobile app, and that is coming. We just wanted to get to a point where we had the core features and integrations ready to go, so we weren't kind of chasing out, building two different interfaces for the same backend that is massively in flux is a path to madness, right? So we had to pick one. I think that we will get there eventually. And I think that we also need the ability for people to use Infinex with external systems as well, which is where a mobile app will also be very helpful. So.
All right. Well, I guess we will see what the further developments are with Infinex. I did also want to ask you, because I saw that you said that you plan to do an echo group for the patron NFT holders. And I wondered if you had, and so this Echo is like basically kind of a 2025 version of an ICO platform. And I wondered what vision you had for what types of projects you would want to invest in.
So I've had that Echo group up for a while now, since last year. After the patron sale, I was waiting to launch the group until we had the patrons live so that we could have a patron gated platform. So it's only available to patrons. And one of the key criteria for doing a deal through our particular group is that we will integrate it into Infinex. So we've done, I think, 5 or 6 different deals now, and most of those have been integrated already into Infinex. So it's a way of just getting alignment, I think, alignment between patrons, the platform. I'm also a big fan of Echo. I think that Echo is just fundamentally a better way of getting alignment for early stage deal flow. So there's a whole bunch of synergies there, I think.
Okay. All right. Well, is there anything that we didn't talk about that's on your mind these days that you would want to mention before we wrap?
I think, there's a bunch of things that are happening with Infinex. Obviously governance is one of the more boring ones. We have just been able to get to the point now where I think we understand what the next phase of Infinex looks like, which is this combination of first-party integrations like Swidge, which is our swapping and bridge functionality. But then we need to be able to support third-party integrations. So the ability to bring your Infinex account in and use it in other places. And I think that that's something that we're working on that is going to be probably the next phase in the project. Once we land that and we figure out the right architecture for that, that will take us through to the next 6 to 12 months, because you'll be able to get new functionality much faster than we've been able to build it to date, by just bringing your Infinex account wherever you do crypto things.
Okay, I don't know if I fully understand. Is it sort of like the way that frequently on a Web 2 site, you would go and when you sign up, it offers you the option to use your Google ID or...
Like SSO. Yeah, exactly. Exactly right. That's exactly what it's like.
Okay, interesting. All right, well, we'll be on the lookout for that. Where can people learn more about you and Infinex?
Infinex is at Infinex_app, and my handle, I guess you can put in the show notes there because it's a bit hard to spell. I can't get the Kain handle on Twitter. It was registered too early.
Yeah, I will put that in there because you're right. It's a little bit hard to spell. But anyway, it's been a pleasure having you on Unchained.
Thanks so much.
Thanks so much for joining us today. To learn more about Kain and Infinex, check out the show notes for this episode. Unchained is produced by me, Laura Shin, with help from Matt Pilchard, Juan Ivanovic, Megan Gabus, Pam Majumdar, and Margaret Curria. Thanks for listening.